This is a video lecture of Chapter 5 of the Personal Finance text. Chapter 5 is titled Financial Plans, Budgets. People often resolve to somehow improve themselves or lives, but while not lacking sincerity, determination, or effort, they nevertheless fall short of a plan, a map, a picture of why and how to get from here to there. This happens a lot when it comes to financial planning, because a lot of people know where they want to get to financially, but discretionary income turns into spendable income in some people's eyes, and it becomes less of a possibility to achieve those financial goals. There's 4 learning objectives to this section. Trace the budget process, discuss the relationships of goals and behaviors, demonstrate the importance of conservatism in the budget process, show the importance of timing in the budget process. So in the budget process, you have like the prequel, you have the pro forma, then you have the actual budget, and then the budget turns into either a strategic plan or a benchmark. Following that, a strategic plan is a goal, and then a benchmark is a reality. There's a couple steps in the budgeting process. Of course, this isn't necessarily etched in stone, but normally you want to first define your goals and gather data. Then you want to form some expectations and you reconcile your goals and data. Then what follows is the actual budget creation. Then monitoring and analyzing the variances of the information that you put into the budget. And then you want to adjust budget expectations or goals. And then the cycle continues once more. So to elaborate, in the defining goals and gathering data step, this is where we're looking at current financial statements. When we're forming expectations and reconciling goals and data, this is where we exercise conservatism. Budget creation is self-explanatory. Monitor outcomes and analyze variances, that's where we observe frequencies. And then again, we come back to this step, adjusting budget expectations or goals. So then once again, go to the stage where we analyze the current financial statement and see what the current picture is. Some key takeaways are that a budget is a process that mirrors the financial planning process. The process of creating a budget can suggest goals, behaviors, and limitations. For the budget to succeed, goals and behaviors must be reconciled. Budgets should be prepared conservatively, overestimate costs, underestimate earnings, because this always helps to get a more accurate idea of your discretionary income, which is the money you have left over. The appropriate time period is one that is short enough to limit the amount of data and long enough to capture meaningful data. Some learning objectives for the creating the budget section of the text are: describe the components of the comprehensive budget, describe the components of an operating budget, discuss the sources of recurring income and expenses, identify the factors in the operating budgeting process, and identify the factors in the capital budgeting process. So here we have the comprehensive budget, which can either be an operating recurring budget or a capital budget, which is non-recurring. The operating budget is going to be for short term, and that's going to encapsulate your living expenses, income, which is normally month to month, any loan payments you have to repay, and savings and investment deposits. Capital budgeting, or non-recurring, is for the long term, and this is where we look at capital expenditures or purchase of durable items. Durable items or durable goods are those things that we could probably buy once and never need to buy for a very long time. such as a car, a house, a refrigerator, um, certain household appliances that you're not going to have to rebuy again the next month and that you can keep for a very long time, a computer, these kinds of things. This is all part of the capital budgeting process, but for the most part, what we're going to be looking at is an operating budget per month, and then if any of these durable item expenses come across the way, you would hope maybe that you can use some of the savings that you've put away, or maybe you can have a allocate some money into an area where you can kind of prepare for these expenses if you can. The operating budget has a couple things rolled into it: macro factors, your financial history, and micro factors. And all of these are things that you have control over and things that you don't. Fixed expenses and variable expenses. Normally, our cell phone bills are almost fixed expenses now, because back in the day we used to get charged per text message and now we don't. So now cell phone bills are usually the same thing every month. Electricity bills, however, we know that they change all the time. In the summer, it tends to be a little higher because we run the AC more, for example, than in the cooler months where we don't need it so much. The operating budget should have financial history or financial statements. The macro factors are economic cycle, unemployment, and inflation and deflation. These are things outside of your control. Micro factors are family structure, health, career choice, and age. And I mean, you don't really have control over your age, but it's something that's closer to you as an individual. Capital budgeting process similarly also has some things roll into it. Macro factors, the time value of money or opportunity cost, and micro factors. And when it comes to just coming back right here, the time value of money, we know for a fact that money loses its value over time because of inflation and how the value of the dollar catches up with inflation, or I should say catches down really with inflation. But when we look at the value of a dollar over like a 50-year time period, it's scary to see it, or over a 100 or 200-year period. So you want to know, like, during your lifespan, or this is kind of silly to say, but however long you expect to live, you can look at that trajectory and see what you anticipate the dollar to be much later on into your life. But of course, this is like super long capital budgeting, and it's not typical of what you'd be doing, which is why I said that um, the capital budgeting is not necessarily something that you're just gonna do, and for big durable purchases such as an automobile or a house, we normally get a loan that we end up paying monthly, and that becomes part of our operating budget, not our capital budget. So some key takeaways: comprehensive budget consists of an operating budget and a capital budget. The operating budget accounts for the recurring incomes and expenses. Recurring incomes result from selling labor and or liquidity. So selling labor, it means you're selling basically your time to your employer and your skills. Recurring expenses result from consumption of goods and or services. Recurring incomes and expenses satisfy short-term lifestyle goals and create free cash flow for capital expenses. And the capital expenses are those durable goods that we talked about, durable items. The capital budget process accounts for capital expenditures or non-recurring items. Capital expenditures are usually part of a longer-term plan or goal. Projecting recurring incomes and expenses involves using financial history, new information, and micro factors and macro factors. Different methods may be used to project different incomes and expenses depending on the probability, volatility, and predictability of the quantity and price. And usually these are things that are beyond your control anyways, but you want to factor that in also. Also, projecting capital expenditures involves using new information and macroeconomic factors, although these are harder to predict for a longer period and therefore less relevant, and the relationship is described by the time value of money. So now we have the section in the text, the specialized budget. Learning objectives are to discuss the use of cash budget as a cash management tool, explain the cash budget's value in clarifying risks and opportunities, explain the purpose of a specialized budget, including a tax budget, and demonstrate the importance of including specialized budgets in the comprehensive budget. So here we have cash, tax, and activity budget. Your cash budget has cash living income over expenses, loan payments, and savings and investment deposits, like we mentioned before. Your tax budget has taxable income, tax deductible expenses, so like donations to charity and stuff. And also, if your tax accountant is good enough to be able to do this, your expenses as a student, that also can be um, that also can be brought up when you're doing your taxes each year. In your activity budget, you have activity income and activity expenses. The cash flow budget is an alternative format used as a cash management tool that provides more detailed information about the timing and amounts of cash flows and a clearer view of risks and opportunities. Specialized budgets focus on a specific asset or activity. A tax budget is commonly used to track taxable activities. Eventually, specialized budgets need to be included in the comprehensive budget to have a complete perspective. Budget variances. Define and discuss the uses of budget variances. Identify the importance of budget monitoring activities. Analyze budget variances to understand their causes, including possible changes in micro or macro factors. Analyze budget variances to see any potential remedies to gauge their feasibility. So now here we see the word varia, and we know that, some of you may know that this is a prefix to words that mean change, like variety, variance, right? It's the same in the Latin languages too. Varia usually would mean changes, like so. Variance would refer to things that can change or can fluctuate. Variances. So budget variances of income, actual, less than, greater than budget. You can invest less or more, labor and capital, and then you can have a lower or higher rate of return on wages and investment return. actual actual budget, you can have a surplus or a deficit, and then that splits into two. You either got a quantity variance or a price variance, and the quantity variance is gonna be contingent upon labor and capital, and price variance is gonna be contingent upon wages and investment return. Actual budget, greater than or less than. Um, use more. Less. I really don't like these slides. They're not very. They don't do a great job of encapsulating what it is that's trying to be said here. But anyway, so your actual budget can either be a surplus or a deficit, and that's gonna cause you to have a variance and determine whether or not you are to use more or less, and also look at cost of more or less per unit so you can determine affordability. That's what this slide should have portrayed. On the expense side, your actual budget can either be have a surplus or a deficit, and this is indicative of a quantity variance and also a price variance, because each item in your budget can change price-wise. Or you can also have a quantity variance if you're being charged any entry on that budget per unit, which I don't know what you'd be charged for per unit, unless it's like groceries and you're very specific on the items that you purchase. So here we have the budget variance, quantity and price. You have micro factors and macro factors for both quantity and price. Micro factors: family, career, health, and age. Same thing for price. Macro factors: economic cycle, unemployment, and inflation. So you definitely don't have any control over this because we're part of a big economic system. And the micro factors, they're closer to home, but they're still relatively hard to control, but easier to identify for you. Key takeaways of this section: recognizing and analyzing variances between actual results and budget expectations, identifies potential problems and identifies potential remedies also. The more frequently the budget is monitored, generally the sooner adjustments can be made and the less costly adjustments are to make. Budget variances for incomes and expenses should be analyzed to see if they are caused by a difference in quantity, price, or in both quantity and price. And variances also need to be analyzed in the context of micro and macro factors that may change. Financial decisions. Describe the budget process as a financial planning tool. Discuss the relationships between financial statements and budgets. Demonstrate the use of budgets in assessing choices and identifying factors that affect the value of choices. Financial statements and budgets are ways of summarizing the current situation and projecting the outcomes of choices. Financial statement analysis and budget variance analysis are ways of assessing the effects of these choices. Financial planning is a continuous process of making financial decisions. Financial statements are ways of summarizing the current situation. Budgets are ways of projecting the outcomes of choices. Financial statement analysis and budget variance analysis are ways of assessing the effects of choices. Personal factors, economic factors, and the relationships of time, risk, and value affect choices as their dynamics affect outcomes. And this concludes the presentation for Chapter 5. In my opinion, everyone, this particular PowerPoint presentation for Chapter 5 is super condensed, and it's not exactly reflective of everything that's in Chapter 5, because Chapter 5 is a pretty big chapter. It's worth the read, and it elaborates on each one of these points. So if you're watching this first and then going back and reading the book, it's a good, you're doing good, because now you're going to catch these terminologies when you get to them in the book, or vice versa is fine too, but make sure you read the book. If you have any questions about Chapter 5 of the Personal Finance text, please feel free to contact me at any time via email, and I'll be more than happy to assist. Thanks and have a great day.